My name is Emily Fletcher. I work for BlackRock Investment Management, and I'm co-manager on BlackRock Frontiers Investment Trust, which is what we're going to be talking about today. So hopefully that's what you're expecting to hear about. If not, please do feel free to go and sit somewhere else, or do stay. It's lovely to have you. Thank you. So a little bit about Frontiers. Frontiers, what exactly does frontier markets mean? So we invest in countries which it's unlikely that you have in your portfolio through other holdings. You can see from the map some of the countries we currently have in the portfolio coloured in. But we invest in all sorts of parts of the world, such as Pakistan, Indonesia, also somewhere like Greece, Poland, Chile, some Saudi, some of the Middle East, all sorts of parts of the world. The way we would define our universe is that if you say there's around 200 countries in the world, of them are about 20 are developed markets, Europe, US, we don't invest there. Then we take out the top 7 largest emerging markets. So we take out China, we take out Korea and Taiwan, we take out India, we take out South Africa, and we take out Brazil and Mexico. And then we invest really in anywhere else there is left in the world. Obviously, not all of those countries have stock markets. Not all of those countries we can invest in. But that's how we would define our universe. And we think it's really interesting because these tend to be the places where other people aren't investing and aren't looking for investments. In terms of why we invest there, why we think it's interesting, I'm going to give you 3 reasons for the basics, or the ABC of frontier markets. The first reason for why we defined our universe is we think it's a great place to be able to look for alpha. And we think it's a great place to be able to look for alpha because no one else is looking there and no one else really has it as a core of their portfolio. Even though some of our countries are emerging countries, we would say that for most emerging market investors, and I think I'm actually in a good place to be able to verify this because I sit within an emerging markets team at BlackRock. But for most emerging market investors, I think around 90% of their benchmark is in those top 7 largest countries. And I think it's about 95% of where emerging market investors would spend their time focusing, talking about, looking for investments. So by the time you step out of that to all the rest of the countries, I think it's really fair to say that it's somewhere international investors really aren't focused on. Who does that mean that who is focused on a lot of these markets? Often it's local, retail, domestic investors, but each of them in their individual countries. So that's why I think it's a great place to be able to look for alpha. Why is it an interesting place to look for beta? Well, actually, a lot of these countries are still growing quite fast. A lot of these countries are places where the theory of GDP convergence holds true in any way. They should continue to grow faster than the West. They don't have to quite the same extent the growth challenges that we all know and are very aware of, both here in Europe and often in the US, maybe not quite at the moment. And so these are places that are really set up to be able to grow faster. And then finally, that C, we come on to correlation. You know, what's so interesting is we go back to who is investing in these markets. And often it's local domestic investors. And that's interesting because they will read likely their local domestic press and be concerned what's happening in their local domestic economics and their local domestic politics. Now, actually, then, if you think about what's really the focus for Kazakh investors in Kazakhstan, you can see that that's obviously completely different to what's likely the focus for Vietnamese investors or for Chilean investors. And actually, there's almost no trade that happens between these countries either. So you end up with, therefore, you can have countries that are quite lowly correlated with each other because they have very few trade or economic linkages, and they have very few political crossovers. And therefore, you get this low correlation. And what you come on to see through that, and we actually have a slide later, is that actually this trust is one of the least volatile funds that we run within BlackRock equities, which is quite counterintuitive, I think, when I started off by saying that we invest in Pakistan, Indonesia, and Greece. But actually, to also say that actually in aggregate, what you get is a trust that's one of the least volatile of all the trusts we run at BlackRock. And so much so that when we first launched this trust, something I was involved in 2010, we wanted to say that therefore that made it less risky. And our compliance department so freaked out with me saying that anywhere that could have those countries in could in any way be considered less risky that we don't say that. But it does have lower volatility. So how do we do this? It is a really, really fascinating place in the world to invest in, but it is really time travel intensive. So we spend a lot of time visiting all these places. As you can see, it's great fun to be in Indonesia, Nigeria, Saudi, Poland, and that's just the last 6 months. We sit also within an organization that I expect you have heard of called BlackRock. And within that, obviously, that we have the advantage sitting within one of the largest emerging market teams in the market, which sits within, obviously, one of the largest equity teams in the market. And we have the benefit of talking to our colleagues in emerging market debt, emerging market currency, and obviously a lot of traders. And it's really important to be able to do that. For each and every single country that we invest in, I think you need to understand what's happening in the political sphere at that point. You know, who's getting elected? Will they still be there in a few years' time? I think you need to understand what's happening economically, you know, particularly where's the current account balance? Are there pressures on the currency? What are the dynamics the central bank's weighing up at the moment? And that's before you then go down into every single stock and look at them exactly the same way you would for a UK stock. You know, for everything that we invest in, it will have a P&L, it will have a balance sheet, it will have a cash flow statement. Typically, all the companies we're invested in will be audited by a subsidiary of the Big Four. They will certainly all be audited, but it's typically, even where we invest, by a subsidiary of the Big Four. We don't invest in things that are super illiquid. Pretty much everything in our portfolio will still trade $1 million a day. So compared with some of the discussions around microcap that were happening in here before, probably even more liquid than that. But it is still a place where, you know, each and of themselves, the countries we invest in can be risky, you know, and it's important to be able to understand all of those political and economic scenarios for the country as a whole. So I'm going to come on then to talk about a couple of things that we think are interesting in our portfolio at the moment. I've got kind of three themes here of, you know, what we like in sort of in broad terms in frontier markets at the moment. So the first of those is we think actually quite a few of the smaller countries are quite interesting at the moment. This is something when we first launched, and actually that was back for the beginning of this, but if you go back 10 years, beginning of this slide, we had, you can see at some point, 35% of our portfolio in some of these smaller countries. And if you can't see it at the back, the countries that are aggregated here are Pakistan, Kenya, Bangladesh, Egypt, Sri Lanka, Nigeria, and Turkey. So just for us, some great examples of within our sphere, the smaller illiquid countries that we can invest in. Now, these looked really quite interesting 10 years ago, but actually post that, we reached the point where we thought valuations are kind of up with events. These are much less interesting countries to be invested in for various reasons. But as of about a year to 18 months ago, we believe that this has now become, again, quite an interesting part of the world to be investing in. And there's various reasons for that. And again, you know, really country dependent. And so perhaps this slide just emphasizes a little bit of sort of how country specific all of the work we do is and how detailed. You know, why has Pakistan become more interesting again? Well, actually, I think it's because they've stabilized their external balances. They're starting to see FX reserves. They've just agreed a negotiation with the IMF. You know, very country specific. Why is Turkey becoming more interesting again? You know, or maybe it isn't as of the events last week, but, you know, maybe it is. Well, actually, we are seeing inflation come down massively. You know, what was the problem we have? You can kind of see on the top right. It's quite easy to see what the problem was in Turkey. They over-monetize. They have massive runaway inflation. Actually, we think they're really starting to get that under control. Perhaps they will, perhaps they won't. But if they do, valuations there, some of the stocks we own are trading on about 3 times PE. So not accounting for a lot of positivity. You know, bottom left, Egypt, somewhere that, again, has had a lot of problems. You know, they've had a big currency devaluation about 18 months ago. Yeah, to 18 months ago, sorry. Is it enough? Well, that's a good question. But actually, remittances growth is really interesting. So that suggests that perhaps the overseas population in Egypt is starting to think it's worth putting money back home again. And we've seen huge growth in that remittances growth. And finally, Bangladesh. You know, well, why might that be interesting again? Perhaps it will, perhaps it won't be. But they have had a very interesting change of government with Sheikh Hasina, who was there for a very long time, having left her position, and Mohammed Yunus in place at the moment. So again, you know, perhaps we see a turnaround there in a country where historically, over the last few years, what they had was floor prices in shares. So the share prices were just not allowed to drop any further than a certain level. And obviously, that meant that everyone basically stopped trading. Second reason, so perhaps that's not the best reason to end on, but we think there's some really good opportunities. Valuations are sufficiently attractive. Macro regimes look pretty interesting. On the political side, I think it's worth stepping into all those 6 countries at the moment. Second area that we think is interesting within this collection of markets really comes onto what we believe that we're seeing geopolitically. So I think it's fair to say at the moment that we have a world in three. We have the Eastern Bloc, we have the Western Bloc, maybe they should be the other way around, and then we have where a lot of our markets are, which is everything in between. If you go look at some of the votes we've had in the UN, there's a huge collection of countries that have abstained on a lot of these votes. Why is that? Well, that's because they want to be able to continue to trade with East and they want to be able to continue to trade with West, and they don't really want to have to align themselves with one side or the other. Now, actually, the majority of the countries we invest in would be in that sphere, and particularly the countries in the Middle East. And I think you can see, actually, from some of the negotiations that have been taking place around some of the most troubled regions, whether that's Russia, Ukraine, Israel, Gaza, actually, a lot of those discussions have been happening within the Middle East, perhaps even DRC. I think some of those have headed up to the Middle East as well. Now, so this is a region that I think has been good at being able to position itself quite well in the middle, neither siding with East or West. And that has made them be perceived as quite a safe place to put your capital, a safe place to store your wealth, particularly if you are from somewhere in the global south and you're looking for somewhere a bit more safer than your own country to put it. I think the Middle East has been perceived as quite a safe place to store your wealth, perhaps sort of new Switzerland in that regard, in some ways. I think you can also add on to that if you look at somewhere like the UAE, it was a region that was able to stay open and continue trading or allowing trading the whole way through COVID. And I think that, again, started to set them up quite well. This is it's beginning to be perceived as a good place to hub your business from. As a result of that, we've just put, to try and indicate this, Amar Group is the largest property developer in the UAE, and we've just tried to put a slide there showing how much they've seen pre-sales of apartments and residential areas increase over the last few years to really try and illustrate that impact that we believe we're increasingly seeing people storing their wealth in the Middle East. And that presents a huge number of opportunities for countries and, for companies in that region. The third reason why we think that these markets are really, really interesting in aggregate is just that they're really cheap. And you can see on this slide that they've always been cheap, but they are a lot cheaper relative than they were. So the discount should be there. These are less developed countries. These are less developed markets. But that discount has grown even over the last 5 years, having started off pretty cheap to start with. And to put that in context of where we are in sort of more absolute terms or multiples, you can see the trust in green, and on the left-hand side or the right-hand side, the other side, you can see MSCI World, and just that huge gap, I think, that's opened up. We would say for our companies that we invest in, if I just move on to this slide, if we'd say for the companies that we invest in, that we expect to typically see earnings growth of 10 to 15% a year. And I think that since I've been involved in this trust in 2010, that's been what we have seen in aggregate is earnings growth of 10 to 15% a year. We're not an income-seeking trust, but we find that the companies we invest in have probably higher culture of paying dividends for historic cultural reasons, perhaps than we see in the West. And so we've invested in companies which pay out the earnings, and we pay them out to investors. And it is interesting to us, I think, as a reflection of how cheap we think these companies are as an aggregate, that we are generating a yield on the trust of somewhere around 5% at the moment. And that's purely through pass-through of the dividends that we see. Going back a slide, you can see, I don't want to skip over it quickly, apologies if it felt like that, but just see the performance we've generated in the trust over the last few years in various combinations. It's been a good time for us relative to our benchmark, and we've been able to pick up on some really interesting opportunities, particularly coming out of COVID when we felt that some of these markets were really aggressively oversold unnecessarily. If we come onto this slide, then to give a little bit of an idea of what I mean when we're talking about where are we invested, what sort of countries are we talking about, what sort of opportunities can you find in this area. So you can see one of the largest markets we have, as I've talked about and alluded to a little bit, is the UAE. They're really picking up on this opportunity of this place, this region emerging as a great place to do business, and some of the opportunities we see coming out of that. We're invested in some property developers there, which we think are really well positioned to take advantage of that. You can see that we have quite a lot of Saudi Arabia, not very much if you compare it to what we could have in Saudi Arabia. We try and think of this trust on a fairly absolute sense. We invest in the companies that we want to, and we're not led by where our benchmark is, particularly. We only run this structure in a closed-ended vehicle. We don't run an open-ended vehicle, and we think that the closed-ended structure is really ideal for investing in this space, because what it allows you to do is only hold the companies in your portfolio that you want to own. Because these markets are much less liquid, if you run an open-ended vehicle, the strong likelihood is that you would have to hold certain positions in order to be able to have sufficient liquidity if you ever needed it on a daily basis in your trust. What we've tried to show with both, where we are on some of those smaller countries and perhaps the diversity that we have in the portfolio here, is just that it is really important to be quite active, we believe, in your decisions as to which markets and which countries you're invested in. If you think that all of the countries in our universe are going through economic cycles, those economic cycles are typically 3 to 5 years long. What's interesting about this space is those economic cycles don't tend to be coincident. So you're able to find some countries that are growing really nicely while others are moving into recession and you'd want to be exiting and not holding your investments there. So it's really important that your trust, therefore, is sufficiently able to move, I guess of a sufficiently small size that it's able to, and the closed-ended structure really gives us the ability to move it as and when we want, and to move it as and where we want. And that's something we do in our portfolio, is take advantage of that flexibility. So other stocks that we have in the portfolio, to touch on perhaps Kazakhstan, we've got one of the biggest fintech operators in the market. It actually does about 80% of payments processing in the country, moving into nearby countries, trying to expand that. Very much a sort of one-stop app, doing extremely well. Philippines, we have a casino operator there that's doing quite well. Particularly, it's a digital platform. It's growing very nicely in terms of operating digital gambling, and that we've seen that grow its revenues hugely over the last couple of years. We have healthcare stocks in the portfolio. We have IT stocks in the portfolio. Moving on to the next slide to give an idea of the country split, you can see we do have all sectors represented in the portfolio. You can see we have a large weight in financials, and I think it's really important just to touch on that quickly, because I think if you were to move into the Western world, come into Europe and think about financials, well, I mean, I could give you Barclays, I could give you Credit Suisse, I could give you Goldman Sachs and HSBC, and all of them would nominally be listed in different countries. But all the business they do is global, and if one went down, there'd be a strong likelihood that all the others would move in a similar direction and go the same way. Whereas actually for us, the banking sector really represents much more the domestic economy and perhaps the domestic consumer, because almost all of the banks that we're invested in would be single country. So, going back to sort of some of the prior examples, the bank in Chile that's lending to Chile investors will really have almost zero to do with the fintech app that's growing very nicely in Kazakhstan, or the banks in Turkey that are benefiting from inflation coming down, because they're all single country. So I think that is very different to what you would see in more developed markets in terms of actually that holding being really reflective of investments in some of the domestic economies that we really like. You can see top 10 positions there. I think the only thing that's worth noting is if you went from the top, that would be Saudi, UAE, Poland, Vietnam, Hungary, Saudi, Indonesia, Kazakhstan, Thailand, Poland. And just to give a flavor of it's really, really spread between lots and lots of different countries. I'm going to come on to just the final slide now, and really just to wrap it up. In terms of what we think we offer investors, we think that we offer growth in that these countries are growing faster than what you find a lot of the rest of the world. Yield, I think I've touched on. It's really interesting, I think, that we are trading on the valuations that we are on, and at those valuations, it does throw up that within the trust, you have a yield at the moment of around 4.5% to 5%. It is low volatility, just to flip back because I've passed really quickly, but there is the volatility on our trust versus various indices. And you can see, I think it's fair to say as the heading, that it is really surprisingly low volatility given the countries I've mentioned. And I flick it on again. No. There we go. In terms of how we manage the trust, it is active management, as I said, actively moving between different countries. It is hard currency return, so it's really important to us to remember that our investors are dollar, well, I guess we'll hear pound, but we think in dollars, dollar investors. So it doesn't matter if we return you thousands and thousands of kwacha, but the kwacha halves, we are really looking to be dollar investors. And that means getting the macro calls right, and it means being in the right countries at the right time. In terms of liquidity management, our board for the trust, the board have promised that every 5 years they will give any investor the ability to exit at NAV less costs. We've had 2 of those 5-year lives, and the final one, the vote will go to shareholders in February 2026. In the previous 2 times, it's been an extremely good pool to maturity on the trust, and we would expect the same for the third 5-year life. Obviously, the form of exit will depend on whether everyone wants to exit or nobody wants to exit. We don't believe in perpetual capital vehicles. If investors want their money out, that's great. If we haven't done a good job, we shouldn't be continuing to run the trust. But so far, in the 2 previous 5-year lives, we've carried on the majority of the money and raised a little bit more in terms of that. But we have seen that to be a very strong discount control mechanism and would expect that to be the same. So 1 more year to go on that before the vote. And and liquidity management in terms of where we're invested. So hopefully that's given you a very brief, and I talk really quickly, so extremely fast, overview of the BlackRock Frontier Markets Investment Trust. It's been an absolute pleasure to speak to you all. Thank you very much.